A new decade for precious metals investing with Monex, featuring managing partner of CPM Group and author of the Monex Precious Metals Outlook Report, Jeffrey Christian.
Hello, my name is Sean Brasney, Sales Director for Monex Deposit Company. I'm here with Jeffrey Christian, Managing Partner and Founder of CPM Group, and one of the many amazing analysts within the CPM Group of analysts. Jeffrey is the author of our New Decade for Precious Metals Investing Report, and he's joined us today. Thank you very much for your time and being with us today, Jeffrey.
It's always a pleasure to be with Monex and to be with you personally, Sean.
You know, we started off this year with our new report, a New Decade for Precious Metals Investing. And boy, what a new decade it started out to be. We came into this year kind of on the heels of last year with a lot of hope for the precious metals, because in June of last year we saw the big banks capitulate from a tightening somewhat idea within their strategy. And then in June, after the Fed policy statement of taking the word patience out, we saw them really flip to be very accommodative and start to call for 3 rate decreases moving forward. And we're kind of riding on the heels of that coming into 2020. And of course, February and March and COVID hit. So we're coming into this new decade, and I want to keep this in perspective. When it comes to how much stimulus was put into the economy, going back to 2008, and the stimulus, the accommodative policy started to come into place, lasted until about, right into 2018. We were able to balloon the Fed balance sheet up to about 4.5 trillion. And then over about a 2-year period, the Fed started going into what was called quantitative tightening, which you were actually very instrumental in helping us to understand. And they were reducing the Fed balance sheet and really creating a cry for dollars and liquidity in the marketplace. And of course, they have been very accommodative since then. But to balloon it up to 4.5 trillion in over a 2-year time frame, only be able to get that down to maybe just under 4 trillion. And then coming into 2020 with COVID, how much more stimulus has been added to the economy since COVID in March?
The Fed's balance sheet has probably doubled since February or so. Looking at M1, narrow money supply, it was about $4 trillion in February, and now it's 6.2 trillion. So we've increased the narrow money supply more than 50% during the COVID pandemic and the economic lockdown. And we've pumped, as I said, probably $4 trillion more into the economy through the Fed buying treasuries and printing dollars to pay for them, with really not that much. I guess you could actually say that we have gotten a return on that investment, in that we're not in a Great Depression.
But we're really not out of the woods yet. I mean, there's still a talk of another 900 billion that they seems to be off the table again, but it's, on the table, off the table. And the precious metals do tend to react fairly well when there seems to be a stimulus package getting ready to go through. But this 900 billion is, if they do it, there's more to come, isn't there?
Yeah, the estimate, and I do believe the 900 billion will get passed. And it'll probably get passed, this month because it's desperately needed. But the 900 billion, economists estimate, will only cover us really into March or April. So, and the Biden people have said, we're willing to accept this $900 billion deal now, because our assumption is that it'll be followed by further stimulus packages in the second quarter and going forward until we get out of this economic quagmire that we're in. So 900 billion really doesn't solve the problem. It only helps keep businesses afloat and people eating until March or April. So there's going to be more. There has to be more, unless the powers that be decide that they really want to accept a depression. And they don't, because the political consequences of a depression are pretty severe for politicians.
Coming into the end of this year and looking forward into next year, with a new administration stepping in place, what do you think the new administration is going to mean for the market?
I think there's a lot of political rhetoric which has nothing to do with the reality. The reality is that the Democrats that are winning, coming into power, Joseph Biden and Nancy Pelosi, these are career politicians, and they're part of the same corporate Democratic and Republican system that has really ruled the country since World War II and has been behind a lot of the fiscal and political problems that we're trying to wrestle with now. Our view has been for years that there are these major issues that need to be resolved, and they keep getting compounded and go unresolved. And every time you get into a crisis, 2000, 2008, now 2020, you have a worse base on which you're working. So you have a new wave of problems that come in, and you have these long-term structural issues that haven't been fixed that make dealing with the recession, the cyclical recession, that much more difficult. And I think that looking at the new administration, it's really going to be basically more of the same. Hopefully we'll have less vitriol and dishonesty, but we're still going to have a tremendous amount of vitriol and dishonesty in Washington, because that's what Washington is composed of these days.
There's a lot of talk about lockdowns. Here in California, they're starting the hard lockdowns again, especially LA. But they have been a little bit more, I want to say, they've taken a different course of action. It's not as hard of a lockdown on everything. They are letting some things operate a little bit more than they were in March. But the lockdown conversation is happening again. And as we look out over a national level, if that starts to happen, there's a lot of talk from the investors about another March liquidation event. Do you see that as potential? And if it does happen, do you think it'll be as severe as it was in March?
I don't see a lockdown precipitating another liquidation the way we saw in March. I think that we're much more well aware of what's coming, and we're much more prepared for it. And we have a tremendous amount of cash that's been pumped into the system since March that probably will preclude that. You could see some other things cause some waves of anxiety among investors, and you could well see some serious downward drafts in the stock market from time to time as financial markets react negatively to developments in Washington. But I don't think that we'll see the kind of liquidation across assets that we saw in March, simply because the financial markets, we're aware of this. We're aware of what happened in March, and we have this enormous increase in liquidity. So we're better prepared. Plus, we've already liquidated a lot of those bad assets.
Jeffrey, thank you for being with us today. Your insight and information is always extremely valuable to us and our listeners and our viewers. And we look forward to the sun setting on this last chapter of 2020 and a new relationship moving forward into 2021 with CPM Group.